I'm Charlotte McLeod with investingnews.com, and here today with me is Greg Hemke, publisher of tfmetalsreport.com. It's been around for 14 years now, and he tells me that he has seen some things, so it's going to be a great discussion today. Thank you so much for being here.
Charlotte, it's my pleasure. It's great to get to know you. You do great work, and it's fun to be on your channel for the first time, so thanks for the invitation.
Yes, I'm really excited to finally be speaking with you. I've followed you for quite some time now on other channels, so hoping that it will be a good discussion. I was thinking, I think many of our audience members will probably be familiar with you, but just because it is our first time talking, I thought maybe you could start by giving me a sense of where you see gold in its current cycle.
Well, it has been an interesting, it's been an interesting 14 years. As you said, when you make gold and silver your sole focus for the last 14 years, you see some stuff. And you don't have to have it be your sole focus for very long before you go, this is not like anything else. This stuff trades in some unusual patterns. And so anyway, we've had that massive rally 13, 14 years ago into 2011. Then we all kind of wandered in the desert for 4 or 5 years. And finally started turning higher again in about 16. Rallied then in 2019. And then the COVID kicked in and everything else. And we put in those highs for gold and silver in the summer of 2020. And then just went sideways in a range. The good thing about being in a price range for that long is it becomes clear to just about everybody that has an interest in the metals of what's going on. It's like, oh boy, if silver ever breaks down below 20, ooh, watch out. Or gold gets above 2100, similarly, boy, that's a breakout. So when you get a long pattern like that of consolidation, got a lot of eyes on it. And so what we've been waiting for the last year and a half was this breakout. When would this actually come in gold? I thought it would be tied to the Fed and the initiation of rate cuts and all that kind of stuff. And it looked like we were getting there late last year. And then, that all those rate cut expectations started to get trimmed away in January and February. But then, boom, all of a sudden gold took off. And a lot of it was due to that breakout. Because we had that, I think about Friday, the 1st of March, if I remember right, gold surged about $40, finished up that week, I think it was 2090 on a clear breakout. And then they had the whole weekend for people to see it. And what happened? We came back the next week and shot another $100 higher as people chased after it, getting the momentum. And has since added on another, $150, $200 on top of that. And so now we're kind of more in the kind of pullback and consolidation period, maybe. We have been for about a little over a week. And that's normal. That's how it works. So currently, you got to feel pretty good that we finally broken out. That's on everybody's radar, and all the long-term charts look particularly solid. But with gold and silver, especially the way they're priced, they're never going to go just straight up. The people that say, oh yeah, to the moon, 3,000, just doesn't work that way. And so we just kind of we're the typical pattern of 2 steps forward, 1 step back. And then the way things look, that should continue for a while, which is good.
Okay. Really good to get that long-term overview. And I have a couple of follow-up questions. The first, I think, is going to be, if we look back to that breakout at the beginning of March, you mentioned how, everyone was kind of expecting that gold breakout might be tied to what's going on with the Fed and interest rates, but ultimately that doesn't really seem to be what triggered it. So for you, what was behind that rise?
It's a really interesting kind of confluence of events. And again, ultimately, it led to the breakout, which led to the surge of new money, new cash, and excitement. And that's not atypical. I first got my stockbroker license 35 years ago, and I spent 6 or 7 years of my career as a stockbroker. And this is true about everything, Charlotte. I mean, anything that makes a new all-time high, anything, usually that generates some excitement, whether it's a tech stock or commodity or anything. And people jump on board. They go, wow, look at that. They chase it higher. On average, it's just kind of a rule of thumb. You get about a 10% rally on top of that, above that old all-time high. And so for my last couple annual forecasts, expecting this breakout, I thought we'd get, through 2,100, tack on another 10%, and that initial target would be about 2,300 or so. Again, what was going to set it off, though, that was the key. What caught everybody, what set it off and caught people by surprise, left it wondering what happened, is we were right at the top of that range in late February. And on the last day of February, we closed higher, like about 2050. I think that was the 13th or 14th week in a row that gold had closed above $2,000 on the spot chart. It was a new high monthly close. All these things going on. And then on Friday, March the 1st, a normal day, we're up about $10. And one of the Fed, well, I call them goons, one of the Fed governors, one of the Fed goons, I'm trying to remember which one it was, Waller maybe? Anyway, he's giving a speech, middle of Friday morning, March the 1st. And his speech was, what's the Fed going to do from here? How do they manage this going forward? And he made 2 points in his speech that day. He said, one, I think the Fed needs to kind of run off its holdings on the long end of the curve and buy the short end and kind of flatten out the yield curve, which in its own right should lead to a recession. But more importantly, he said, if we do that and we lessen our holdings on the long end, that will give us room for the next asset purchase program. What did he say? He said the next asset purchase? Wait, another QE program? Boom. Gold went up $30 in about, 2 hours that morning and finished up that Friday at what we were talking about, 2095, 2097, something like that. All these breakouts. And so it was just kind of this confluence of events that just happened to kind of work in gold's favor, and then it took on a life of its own. So that's what led to it. That's kind of why it caught everybody by surprise, just because of where gold was when Waller made that speech. And now here we are.
Here we are. Yes, I remember that day very clearly because we were just heading off to PDAC and we had all these interviews scheduled over the weekend. So we're waiting to see what happened, and it was a very interesting time. So thank you for going into that. And I'm wondering for you, so what are the key factors you're watching right now for the gold price? Because as you mentioned, things have kind of panned out with different surprise things influencing the price. So what are you focusing on right now?
Well, since this breakout happened and we got to 2,300, then a couple of kind of ancillary things have taken place the last few weeks. We had this ramp up of geopolitical concerns and and kind of a safe haven bid that came into the gold futures really around the world because, what's going to happen in the Middle East. And that drove us up over 2,400 twice and kind of painted a little bit of a double top on the chart. You could at least make that case now. It went up there on geopolitical concerns, but nonetheless, the chart's the chart. On top of that, you had this kind of what appears to be a pickup of maybe retail speculation in China, where the Shanghai Futures Exchange came in and said, we're going to tamp this down by raising margins and limiting the size of positions that people can take. And that kind of finally took hold and ran into some profit taking back on Sunday and Monday. And that's when we had gold fall or whatever, Once that tumbling momentum happened there, it tumbled into Asia. Then we got onto COMEX and more selling and profit taking came in. COMEX had its own couple of margin hikes. And so all of a sudden, you bought at 2,400. Now we're 2,350 and the margins are going up. Just get me out. And then you just get this kind of cascade down for 24 hours. So from here in the short term, and we're in this kind of consolidation phase, which is fine, because like I said, gold never goes up in a straight line. It goes 2 steps forward, 1 step back. We get this rush of speculative money. Everybody buys it until it runs out of momentum, and then it tips over, breaks a moving average, that kind of thing. Speculative money comes back out. You get like a 50% pullback. And then something happens, and you go back up, and you make a new higher high, and then you come back down and make a new higher low, and that's kind of how bull markets and the precious metals play out. And so we're just kind of in that pullback phase at this point. What we might need next is this demonstrable, whatever the right word is, slowdown in the U.S. economy. We've gotten some kind of a little shakier economic data lately. I think the main thing for people to watch, especially in the next week with the next FOMC meeting, is that Chairman Powell has said, he said, well, inflation is our number one thing, but I'll put that on the back burner if I sense any weakness in the labor market. So we don't want to be too late in cutting. And he said that twice after the last FOMC meeting. So he's going to be out there again next week. He'll probably reiterate that, probably. Then we get another jobs report on Friday the 3rd. If we get some hints then that, oh, no, wait a second, maybe rate cuts are possible again, because now everybody's starting to think, maybe we're going to get a rate hike. If possible rate cuts come back in the picture, we're already up here at $2,300. That could be the next spark to get us, that next leg higher. So that's what well, that was a long answer, Charlotte, but hopefully I painted a picture of what people should be watching for.
No, that was great. I think there's some familiar factors in there that I think, we'll keep watching those to see how it goes. So I wanted to ask a little bit more about the geopolitical angle. So of course, we've got all these tensions going on in the Middle East, but another factor that I've been hearing for a long time as an underlying reason for gold's price rise is de-dollarization and going back to Russia being kicked out of the SWIFT system. And now I'm just going to check my notes and make sure that I've got it right here. I believe we've got the U.S. looking to potentially allocate Russian assets to U.S. banks to Ukraine. So I wonder your thoughts on that and how that could play out there.
It's a really bad idea. As most politicians go, it maybe feels good. We're going to stick it to those Russians, right? And there's precedent. In the past, you lose a war, right? You maybe get stuck paying reparations for the damage you caused. I mean, look at World War I as an example. Problem is the war's still being fought, right? And so that's what makes this unprecedented. I remember at the end of 2022 and into 2023, when it would come up and we'd do like a year in review or interviews with people, I'd say, the war is a big deal, don't get me wrong, but the most significant thing that happened in 2022 with the biggest long-term ramifications is what you mentioned. First weekend of March in 2022, the war's been going on a couple of weeks. The U.S. kicks Russia out of SWIFT and freezes about $350 billion worth of their foreign currency reserves that were not held in Russia. Well, that's a pretty big deal if you're Russian or Chinese or you name the country. What the U.S. basically said is you either play ball with us, you do whatever we think is okay, or we're going to just cut you off at the knees from the financial system. Well, we may not, look at something China is doing or India is doing or Russia is doing for that matter, whatever, as being in the U.S.'s best interest, but they may be looking at it as their own best interest. And so inevitably, China or someone is going, at some point, the Americans aren't going to be happy with us either, because we got to pursue our own policy. And what happens if they cut us off, which they've now shown they'll do? So that sped up. It's like you reach down, like on a Wheel of Fortune when Pat Sajak reaches down and he gives the wheel a big shove. That's kind of what that did. It sped up this whole de-dollarization thing, because these countries look around and go, oh, wait a second, we can see how this is going to go. We better have an alternative in place for when, if America does even more of this kind of stuff. Well, now they started floating these trial balloons about 6 months ago about, if Congress isn't going to give any more money to Ukraine, well, why don't we just take some of this Russian money and give it to them? And it feels good. As a policy, like I said, well, we'll just take it from. Well, boy, what a terrible precedent it sets in terms of rule of law and international monetary system and abuse of this global reserve currency status that the U.S. has. And so by doing what the U.S. did last week and a few days ago, by now setting in motion to at least see some of it, not much, like $8 or $10 billion, but nonetheless, it kind of opens the door for the EU countries to do the same. That's old Pat, just give the wheel another big old spin. One last thing about that, Charlotte. A lot of times I'll hear people interviewed or I'll read stuff on Twitter or whatever that make this de-dollarization thing seem like it's like this binary choice. Like it's either A or B. You're either the U.S. currency or it's this. And there's a one point in the middle that marks it. No, it's not. By offering this currency, which they'll ultimately do, all it does is it draws demand away from the U.S. dollar. Okay, you have a different platform. You don't need the dollars as much anymore. People will still be using them. We'll still be using them in the U.S. I mean, they'll still be used in the West, but the demand for it globally will go down. And it's like any other good that we learned about in Econ 101. You've got a supply curve and you got a demand curve, and where they meet is the price. And if the supply is going up because of all the debt and the demand for it is going down, it equates to a lower price. And that's what this de-dollarization thing ultimately does. It makes a lower value of all the different fiat currencies, especially the dollar.
Okay, sorry to send you off on a little tangent there, but I think those are important points for everyone to keep in mind.
That's what I do, man. That's my ADHD kicking in. I just go off on all these there. So anyway.
There you go. Okay, I'll bring us back to gold again. So you mentioned we're in a pullback period for gold. We'll hope to post this in the next couple of days. We'll see where the price is at that point, but this is natural. So for you, we need to have these pullbacks before we go higher. I think people are looking ahead to 2024 and they do wonder what the price potential is. So curious about your thoughts as we go up in this step fashion.
Well, now that we've come this far, I mean, you have to start looking at potentially what the next goal would be. And there are a lot of technical targets that all kind of line up around 2650 or 2700. I mean, even if you just pull up an old logarithmic chart of the price of gold and connect the 1980 high to the 2011 high and just draw a line, that's about 2,700 as well. So that's probably the next target. In my forecast this year, I didn't think we'd break through 2,300 until late summer, early fall. And then you'd run up and then you get the inevitable pullback. Well, we've already broken through. We've already run up and now we're in the pullback and it's only April. So there's definitely room to extend even higher. Let's just say maybe we can finish the year 2,500. That would be a pretty good year. That'd be 20%, be double what the average has been since the turn of the century. So that would probably be a feasible target at least. You can always be better than that, but I think that would at least be, to me, that sounds manageable, like and workable.
That does sound reasonable. Okay, so we've got a pretty solid look at what's going on with gold right now, and I have to make sure to ask you about the gold stocks as well, because generally I think people would expect or hope for them to outperform gold, which maybe in some cases we see that happening, but as a group, not just yet. So what are you seeing among the gold stocks? What do you think may be causing that disconnect, and when do they perhaps catch up?
Well, the mining shares are I've sworn them off multiple occasions in 14 years. And they're driving people crazy again. I'll give you a good example. If people want to buy a mining share, a mining company, they'll call up their broker. The broker said, doesn't know, maybe. Where you are in Vancouver, people know more about, the mining sector. But like in the U.S., they'll call their stockbroker will buy them Newmont, right? Barrick. Well, you can pull up a chart. The shares of Newmont and Barrick are at the same level they were 20 years ago. And the price of gold is 5 times higher. And so what that means in the end, for anybody that wants to try to get some leverage and, make a couple extra bucks by trading the mining shares. I mean, my side's always just been about physical metal and preparing for, the end of this debt cycle. I mean, you want to make a few extra bucks in the mining shares, you've got to be really smart about it. And that's hard, man. Even I sit there and grade and grams per ton and, all this stuff. I mean, I have my own experts I turn to, and that's what people should do. You've got to be selective. You've got to know, the company's got to be streamlined. They got to manage their costs really well. They've got to have reasonably high grade that they can get at, so their all-in sustaining costs are low. Point is, if you're going to be in the mining sector, and you're smart about it, you can do okay when most people are being frustrated, because they just own the GDX or something like that. The only other thing I'd add to that then, Charlotte, is I'd invite anybody to inspect this on their own. Go to a chart, like barchart.com is a site where you can put two things together and plot them together over time, and you can see if there's a correlation. I don't know why, but one of the tightest correlations to the GDX, a big gold miner ETF, is actually silver. Doesn't make any sense, right? I mean, I think they go down to like the 14th largest holding to find a silver company, but it is, I mean, it's there. Your eyes don't deceive you. And so if you want to get the mining shares to really perk up and get a flow of funds and see the GDX get above 33 and go back to 40 and 45, you're probably going to need silver to break out and start trading with a 3 handle. That day's coming, so the good news is that means, you haven't, train hasn't left the station yet. But it's just an odd peculiarity of life in 2024 that if you want the gold miners to go up, you're going to need silver to go up to make it happen.
Right. And maybe this is a good pathway into talk about what's happening with silver as well. So with silver, we tend to hear silver follows gold, although it lags behind. Is silver performing as you would expect right now, given what gold is doing?
Well, it is moved to catch up, at least. I remember telling people when gold first got above 2,100 and then it went to 2,200 and then, started moving to 2,300, and silver was still at like 24. And I've been talking to a few people off the ledge by saying, look, if you believe gold's going higher, which I do and a lot of people do, silver is eventually going to go just by virtue of the gold-silver ratio. Gold's not going to $2,500 an ounce, and silver is going to stay at 25 and have the ratio be at 100 to 1. That might only be 80 to 1, but silver is then going to get, it's going to break out. So silver finally did kind of rush to catch up over the last 3 weeks. Got 29. Talk about charting. I'd invite anybody to pull up a chart of spot silver over the last 3.5 years. Find the times when it has gotten to 29 and notice how quickly it was reversed. In the calendar year, in the summer of 2020 to the summer of 2021, it got up to 29 3 times. The very next day, each time, it got a big, massive red candle and shoved right back down. Just in the last 2 weeks, we've seen that same phenomenon. So there's a little line in the sand it has to cross. So you may need gold to keep going to get it to where that finally happens. And the good news is, when I said about gold and how it got above 2,100, then added 10% and get this rush of excitement because it broke out and made a new all-time high. But most importantly, it broke out of that long range. Silver hasn't done that yet. Silver is still roughly, it's at the top end, up near 28, but it's still kind of in that same range that it's been in now coming up on 4 years. So when silver breaks out, then you're going to get this big, huge surge, to 34, 35, 36 pretty quick, just like what we saw with gold go from 2,100 to 2,300. When that happens, it'll drag the shares along. So again, the good news of all this is that it hasn't happened yet. So there's still time for people to kind of position themselves accordingly to profit from it.
That is good news. And I think hopefully we're all familiar with the connection between gold and silver. I've also heard you mention a connection between silver and copper, which I thought was interesting. And I wondered if you could go into that. Is that an industrial metals kind of thing? Is it like a byproduct production? What is going on there?
It is. It gets back to the, algo HFT dominated world that we live in now, right? I mean, so much of the daily volume and everything is now just computer driven, where the computers see a signal or a headline or whatever, and then they respond. They see the dollar go up, so that they dump their gold, that kind of thing. Well, it would make sense that there'd be a correlation between copper and silver, and there has been for decades. But particularly now, because they're both, they're industrial metals. They're both very good conductors of electricity. There's this kind of green economy type trade that's out there. Well, copper has some very interesting let's say supply characteristics to it, the amount of above ground supply, the amount it's been levered, particularly in China for trading instruments, a little bit like silver here in the U.S. And copper's been moving up rather steadily over the last several months. Now, is it because of the global economy? Is it, the dollar's been rising? There are a lot of, maybe it's just a simple kind of short, above ground supply shortage, maybe. Anyway, if copper keeps going up, this is like gold and that gold-silver ratio, like you said, Charlotte. If copper keeps going up, starts moving up to $10,000 a ton, $5 a pound. It's about $4.40 or $4.45 a pound now. Moves through the old highs from a couple of years ago. It's going to get attention. And it's probably going to go from 10,000 a pound to 12,000 a pound. I've seen like Robert Friedland talking about this. Well, again, that's talking from going from 440 to 6. You're not going to have gold, trading at whatever it's trading at that point. Copper's trading at 6, and silver's still trading at 26. The machines won't let that happen. And so keep an eye on copper too. It could be the key to just kind of forcing silver up through 29 and into the 30s, and from there to take on a life of its own.
Okay, we will keep an eye on copper as well. And as we're wrapping up, I'm wondering if we can talk a little bit about strategies for investors right now, because sentiment I see is very interesting right now. I'm not sure what you're seeing. I think people are not sure still if these are real moves we're seeing in gold and to a lesser extent silver. And maybe they're wondering how to play it. So what are your thoughts, keeping in mind that, of course, every person is different?
Well, I'm going to kind of go backwards on that answer. I used to trade a lot, and I don't really do it so much anymore. I actually, in the last month, I made some money trading silver options, COMEX silver options, but that's just luck. I timed it right. You could just as easily have timed it wrong. I advocate against trading to a great extent, because it's almost like, betting sports. You might be right a couple times in a row and you feel pretty good about yourself, and then you just, give it all back. What we talk about on my site is what I said, kind of preparing for the inevitable collapse of this debt-based system we call the Great Keynesian Experiment, because you reach a terminal phase. And I think we're finally now getting there, where the debt is growing exponentially and so quickly that the amount of new fiat money creation even just to service the debt, it all just, just begins to just spin tighter and tighter and out of control. Your protection against that sort of collapse has always been the ownership of physical gold and even in physical silver too. That's your safe harbor in a storm. So people can trade this. They can get all excited and day trade, or they can maybe try to make a little long-term investment in a, really solid portfolio of mining shares and that sort of thing. And that's fun. At the end of the day, what we really need to be worried about, again, is this debt-based monetary system that we're in. And the dollar is the world's reserve currency. People think because it's always been that way for as long as they've been alive, since 1944, then it's always going to be that way. That tomorrow's always going to be like yesterday, but that's not the case. It's not always going to be that way. And people need to be prepared for when that comes. So that's, like I said, kind of answer your question backward. It's okay to trade, and it's kind of fun, and it can, if you get the trend right, you can profit handsomely. But in the end, what we want to be doing is stacking physical metal in your own two hands. Don't own it at some bank and get a certificate for it that they say, oh yeah, come back in 90 days, we'll get it. No, take delivery, store it yourself, own it yourself, and that is your safe harbor through this financial storm. And that's the big picture stuff that we have to be prepared for.
Okay, I think very solid point to end on, but before I let you go, I'll put it back to you in case you had any final thoughts, or if you want to let people know where they could find you.
Well, I guess the thing I would leave everybody with, this is what I do for a living. I'm kind of everybody's eyes and ears. There's a small monthly fee to be a part of my site, but I got to watch this stuff every day, 5 days a week, and it's really almost a 24/7 thing to try to keep track of all the different moving parts that affect the precious metals. But this is a critical time. It's not just my site. This is a critical time for people to follow your channel, for example, and get information that's outside of the mainstream, but objective and honest. It's like this is what we were just talking about with the mainstream media. If you were only listening to Bloomberg or CNBC or, BNN up in Canada, and you get these analysts on there all day long, we don't know why gold's going up. Doesn't make sense to me. Real rates are still high. I don't know why. Well, I just explained to everybody why. And so you have to have some honest, objective, trusted source of information. You're just going to be lost because, again, we're in a period now that is where tomorrow's not going to be like yesterday. So you got to be thinking outside the box. And so I provide that at the site. The people that use my site provide great information all day long too. So I encourage everybody to check it out. Just tfmetalsreport.com. It's a fantastic community. People around the world, all political, we're all in the same boat. So we might as well help each other out. And that's what we do there. Going forward, like I said, keep an eye on Powell next week. Keep an eye on the jobs report, because again, he said several times last month that if he sees the U.S. job market weakening, he will act preemptively and put the inflation fight on the back burner. So if we on the first Friday of May or the first Friday of June, all of a sudden you get a big up, all of a sudden unemployment's 4.2% or something like that, the metals are going to boom. And you'd be left wondering why. Well, keep an eye on that kind of stuff, because that'll be the kind of the rationale for the next surge forward.
Okay, thank you very much for going into all these things going on with gold and silver. And I'll leave a link to your website as well in the video description so people can check it out if they want to learn more. Thank you very much.
Hey, Charlotte, thank you. It's a pleasure getting the chance to visit with you. So feel free to call anytime. I'm always happy to help.
Oh, I will definitely. I'll give you another call very soon. And once again, I'm Charlotte McLeod with investingnews.com, and this is Craig Hemke. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.